Hey, my name's James Nicholson and welcome to my YouTube channel. In this video, I want to talk about the government is proposing to relax legislation and regulation on mortgage lending. And this will have a considerable impact on first-time buyers, but I also believe that it will massively impact house prices. So I want to talk to you about what they're proposing, when could this happen, how this could impact house prices, and much, much more. So if you're new around here and you haven't done already, do subscribe to the channel over there and hit that bell notification. We've got 2,000 subscribers already this year, which I really, really appreciate. We got to 35,000 subscribers. Now we're on the journey to 36,000 subscribers. And let's get some views on this video. More people need to know about what is happening, because if you're going to buy a property, this could make a big difference to you. So smash like, tickle like, do something to that like button. That helps with the YouTube algorithm and it'll get more people aware of what is going on. So the regulators in the UK, they're proposing to massively relax mortgage lending. Now, you might be watching this thinking, great, this is really a great opportunity if you're a first-time buyer. Potentially, you're going to be able to borrow more money. But you also might be an investor that's been in this for a while, or a homeowner that's been in the market for a while. I started investing in 1999, and you might be thinking, this seems like 2008 all over again. So in 2008, or prior to that, it was so easy to get a mortgage. And that isn't great if you're a first-time buyer now and you're struggling to get on the ladder. You might think, why was it so easy? Well, there were mortgages out there called self-cert mortgages, self-certification. And in those mortgages, you could, and people did, just say how much they earned. And there was no proof of earnings. They were crazy. They would literally give money to people. Now, for a lot of people, that worked out okay because they were able to borrow, they were able to manage the properties, and that really did work very, very well. But lots of people also overextended themselves. You could get a mortgage that would give you 110% of the value of your property. So what does that mean? Well, it means if you bought £100,000 property, they would lend you £110,000, and they would have the idea that would be that you would use that £10,000 to get a new kitchen, a new bathroom, and increase the value of the property to do it up. But what actually happened was people would buy cars, they would go on holidays, and then when the market dropped in 2008, 2009, 2010, they'd suddenly be in negative equity. So what I mean is, they would owe the bank 110,000, but suddenly their property's only worth 80. That meant that some people just quit the properties, gave them back to the banks, and the banks ultimately collapsed, losing lots of money. So this isn't going to be that bad, but what they are proposing is to loosen, first off, the salary multiplier. So at the moment, you can borrow around 4.5 times your salary at the moment. Now, there are some lenders out there already that will lend 6%, but they're quite strict still. But what they're proposing is that this will be relaxed. So what will that mean? Well, it will mean quite a lot. So let's just say you had a £20,000 salary right now, and you could borrow 4 times your salary. You'd be able to borrow 80 grand. And most people buy a property at the maximum amount, especially first-time buyers. They buy the maximum amount that they can borrow at. But let's just say this gets changed to 6 times the salary. Now you can borrow £120,000. So what will ultimately happen is people will buy more expensive properties, and I believe that this could push house prices up if they allow you to borrow more. Now, why are they considering this? Well, arrears are at lows at the moment. They're not massively increasing, even with the interest rate rises that we had, because a lot of us that borrowed, we were stress tested at these higher rates that we're at now. So it worked. That ultimately was what it was for, to check that if we were on a 2% mortgage, could we afford it if it went to 6%? It did go to 6% and people were able to afford it. Arrears at the moment stand at 1.08%. So 1% is what arrears. That's nowhere near what we had in 2008, where it got to around 3 or 4%. And repossessions are also low at the moment. And so lenders have gone to the Bank of England and the Financial Conduct Authority, and they're saying, look, people are keeping up with payments. You are stopping us lending more money and stopping us growing the property business that we've got by restricting us. And so they're looking at relaxing stuff. Now, what they're also going to take into account here is rental payments. So this is interesting because I've seen this, and you probably know somebody in the same situation. Like, I know people that pay £1,500 in rent and they can afford it. They make the payment every month. They don't enjoy making that payment, but they do. Every single month they make that payment. But then they look at a mortgage and they apply to a mortgage, and the mortgage payment would be £1,000 a month. But the bank says, you can't afford that. You don't pass the checks. That isn't logically making sense to a lot of people. So you're saying I can afford £1,500 in rent because you have to go through affordability checks on that, but I can't afford a mortgage that's £500 less. And so they are going to look at your rental payment history in the calculation. This is going to be brought in to the calculation for affordability. And that's good because there are lots of people that can do and are making regular rental payments at higher amounts. And if they got a mortgage and they own the property, their monthly payment would drop, but they're currently getting denied, and it just doesn't make sense. And that is something that they're going to address in this as well. It's not just going to be looking at your salary. It's not just going to be looking at your credit rating. It's going to be looking at, do you pay your rent on time? And that's going to be taken into the consideration as well. So this is probably going to be a very big game changer. It's going to get more people on the property ladder, but I do think it's going to drive house price inflation. I think this is going to push house prices up, especially at the lower end of the market in flats and stuff like that. But I do see it as a positive step in order to get people onto that property ladder. This also isn't going to, if Labour are saying that they're going to bring houses down and make them more affordable, this isn't going to do that. This is going to do the opposite effect. It's going to allow people to borrow more money. That's going to make banks more profit, and it is going to drive house prices up for sure. But if it does help people get onto the property ladder, I kind of see it as a win. And that's important because there are people that are wasting thousands and thousands and thousands of pounds a month on rent that could afford a mortgage, that just haven't been able to get there because they don't quite meet the criteria. So for those people, I think this is a massive positive step. Let me know your thoughts, questions or observations on this below. I don't think many people have talked about this story over the last few days. Do smash like, do subscribe, and do check out all the other content on my channel, including this video right here.